In an era of rising inflation, market volatility, and increasing interest rates, building wealth may seem more challenging than ever. However, the wealthy continue to grow their fortunes, often through strategies that are hidden from the average person. While some of these methods require initial capital, many rely more on strategy, patience, and a deep understanding of financial systems. The good news is that several of these approaches can be scaled and adapted to different income levels, making the seemingly unattainable more accessible. One key tactic used by the wealthy is strategic debt, leveraging rather than owing. High net worth individuals understand that not all debt is created equal. They use low-interest loans to acquire appreciating assets like real estate or businesses rather than tapping into cash reserves or selling investments. For example, Jeff Bezos famously borrowed against his Amazon stock rather than selling it, which allowed him to access capital without triggering capital gains taxes. The takeaway is that debt can work for you when it's tied to an appreciating asset or a cash-flowing business. Another lesser-known wealth-building strategy is investing in private equity and alternative assets. While the average investor is focused on the stock market, the wealthy are putting their money into private equity, venture capital, and hedge funds, which have historically offered higher returns. According to McKinsey, private equity investments have generated an average annual return of around 15% over the past 2 decades, outperforming public markets. Even though these high-barrier funds aren't always accessible to regular investors, options like real estate investment trust and crowdfunding platforms provide an opportunity to gain exposure to alternative assets. The infinite banking concept is another sophisticated strategy. Instead of borrowing from a bank, the wealthy borrow from themselves, using whole life insurance policies with cash value. They can take loans against the cash value of these policies at low interest rates, while the principal continues to grow tax-free. This creates a self-contained financing system that allows them to fund investments or business ventures without dealing with traditional lenders. The result is a source of liquidity that continues to grow even as it's being used. Tax optimization is one of the wealthiest individuals' most effective tools for preserving capital. Through the use of holding companies, family offices, and irrevocable trusts, they minimize taxable income, protect assets from legal exposure, and transfer wealth more efficiently. For instance, setting up a Delaware holding company allows businesses to reduce state taxes and shield profits from certain liabilities. While the average person might not have access to complex tax structures, strategies like maxing out retirement contributions and harvesting tax losses can offer similar advantages on a smaller scale. Real estate remains a cornerstone of wealth creation, especially through tax-efficient strategies like the 1031 exchange. This allows investors to sell a property and reinvest the proceeds into a new one while deferring capital gains taxes. Over time, the wealthy trade up properties, compounding their returns while avoiding tax hits. The combination of property appreciation and rental income makes real estate a reliable long-term strategy for building wealth. Another stealthy approach is the creation of passive income streams through dividends and rental income. While most people focus on increasing their salaries, the wealthy prioritize cash flow. A dividend stock portfolio paying 5% annually on a $1 million investment generates $50,000 a year, enough to replace a middle-class salary without touching the principal. The key is accumulating assets that generate consistent income, allowing money to work even when the investor isn't. Lastly, many wealthy individuals engage in quiet philanthropy through charitable foundations, not just for social impact, but for tax benefits and legacy planning. Donating appreciated stock or real estate to a foundation creates a charitable deduction while reducing capital gains exposure. The common theme among these strategies is that the wealthy understand how to make their money work for them. They leverage debt, tax laws, and alternative investments to compound returns while preserving wealth.